I want you to hold one number in your head: $58 billion. That's how much Japan spent on weapons in 1 year, not spread across allies, one country, one check. Here's the part nobody is saying out loud. Every dollar of that came from borrowed money, and the country they're pointing those weapons at, it's the same country that's been keeping Japan's economy alive for 30 years. This is not a military story. This is the most expensive financial self-destruction in modern history, happening right now while most people are watching something else. Japan is arming itself against its own banker. China is collapsing while reporting growth. And somewhere in the middle, a $1.2 trillion financial time bomb is sitting underneath your pension fund and your mortgage. And most people have no idea it exists. Stay with me, because this touches you directly. The real conflict between Japan and China is not happening in the air. It's happening in bond markets, in bank balance sheets, at currency trading desk at 3 a.m. The casualties aren't soldiers. They're your savings, your supply chains, and the global economy you depend on every day. One number will reframe everything. Japan's national debt, 235% of GDP. Plain language version. You earn $100,000 a year. You already owe $235,000. You can barely cover the interest. And this year, instead of paying anything down, you just ordered 147 stealth fighter jets and a stockpile of cruise missiles on credit. That is Japan in 2026. China? China is sitting on an estimated 1.5 quadrillion yen in non-performing loans, rotting debt buried inside its banking system. For comparison, Japan's catastrophic bubble collapse in 1991 produced 100 trillion yen in bad debts. That nearly destroyed Japan for 3 decades. China's number is 15 times larger. Two giants, both bleeding internally, neither admitting it, both accelerating their own collapse while pointing at each other. The clock is running. Nobody rang the alarm. Japan and China are not just neighbors with a historical grudge. They are each other's most critical economic lifelines. China is Japan's single largest trading partner. Over $300 billion in trade flows between them every year. Japanese precision machinery, semiconductors, automobiles into China. Chinese electronics, components, consumer goods back into Japan. Now, here's where it becomes almost impossible to believe. Japan just approved a defense budget of 9 trillion yen, $58 billion, explicitly designed to build weapons capable of striking Chinese military infrastructure, not defensive systems, offensive counterstrike capability, long-range cruise missiles with a 1,600-kilometer range, hypersonic vehicles, F-35B jets launching from converted aircraft carriers near the Senkaku Islands. Japan's own 2025 defense white paper uses the language, ability to hit enemy bases before they launch. Enemy bases. That means China. The same China that bought hundreds of billions in Japanese exports last year. Japan is borrowing from global bond markets to build weapons aimed at its biggest customer and raising taxes on citizens already crushed by a 54% collapse in the yen's value. To pay for it. This is not geopolitical strategy. This is a slow-motion economic suicide pact, and the defense contractors cashing the checks couldn't be happier. China announced 5% GDP growth for 2025. Confident, surging, it is not. The Rhodium Group, the most rigorous independent research firm on China, estimates real growth was 2.5 to 3%. Some analysts believe it was effectively zero. Here's the proof that needs no analyst. China's total government tax revenues dropped 1.7% year-on-year in 2025. First decline since the pandemic. If an economy genuinely grows at 5%, tax income does not shrink. That's not politics, that's arithmetic. The property market is where the real crisis lives. At the peak, real estate and related industries accounted for nearly 30% of China's entire GDP, an entire economic ecosystem built on the assumption that prices would rise forever. They stopped rising. Then they collapsed. Property investment fell 17.2% in 2025, the fourth consecutive annual decline. Home prices across 100 major cities dropped 7.6% year on year. In some cities, prices have cratered more than 40% from their peak, back to 2016 levels. Families who borrowed everything at the top in 2021 are holding assets worth half of what they paid, while carrying 100% of the mortgage. Over 60 major developers have defaulted or entered debt restructuring. Evergrande, once the world's largest real estate company, ordered to liquidate. Country Garden is trying to erase 78% of its $14 billion in debt, offering creditors 22 cents on the dollar. Vanka, considered a safe state-backed developer, had its CEO detained by authorities in January 2025. This is not a correction. This is a controlled demolition of the world's second largest economy. China's banks are holding the rubble. Non-performing loan ratios projected to reach 5.4 to 5.8% by 2027. On a loan book the size of China's banking system, even 1% is hundreds of billions in losses. Losses that have not been acknowledged, not written down, not explained to anyone outside Beijing's inner circle. The losses exist. They're just hidden. What happened on January 20th, 2026 should have led every financial program on Earth. It didn't. That silence should concern you. Japan's government bond market, $7.3 trillion, one of the largest sovereign debt markets in history, broke in a single trading session. The yield on Japan's 40-year bond surged past 4% for the first time since that maturity was introduced in 2007. The 30-year bond saw a quarter-point jump in one day, the largest single-day move since 1999. Traders who had spent entire careers in this market stood at their screens, unable to explain what they were watching. Within hours, the contagion spread globally. U.S. Treasury markets moved. Global technology stocks fell. And then something that almost never happens outside full financial emergencies. U.S. Treasury Secretary Scott Bessent personally called his Japanese counterpart as panic spread through international markets. The top financial official of the United States made an emergency phone call because Japan's bond market scared him. What triggered it? Prime Minister Takeichi announced a snap election and promised aggressive tax cuts and new spending, on top of a record 122 trillion yen budget. Markets ran the numbers and reacted with one unified answer: this country cannot afford what it is promising. Japan's debt to GDP, 235%. The United States, criticized globally for reckless spending, sits at 121%. Japan's debt is nearly double proportionally, and here is the trap with no exit. Raise interest rates to protect the yen and control inflation, which has exceeded the 2% target for 4 consecutive years, and you make 235% debt catastrophically expensive. Debt servicing costs already jumped 10.8% in a single year, crossing 31 trillion yen for the first time in history. Keep rates low and keep printing money to buy your own bonds, and the yen continues to collapse. It has already lost 54% of its value against the dollar over 6 years. Japanese households are paying dramatically more for imported food and energy, fueling the exact inflation you're trying to stop. Raise rates, debt crisis, hold rates, currency crisis. There is no third door. Every yen spent on missiles accelerates toward both. While Japan and China race toward financial exhaustion, someone is counting record profits. Mitsubishi. Heavy industries delivered 150% stock returns in a single year. Defense orders doubled to a record 1.6 trillion yen. Market capitalization now sits at $102 billion. That is not a company reacting to a crisis. That is a company that built a business model on one. Lockheed Martin, Raytheon, the full U.S. defense complex, collecting billions from Japan's program. 147 F-35 stealth jets at roughly $100 million each. 400 Tomahawk cruise missiles, Patriot batteries. Japan is on track to become the world's second largest F-35 operator, behind only the United States. Fear is the most profitable commodity that has ever existed. More reliable than oil, more scalable than tech. As long as China positions warships near Okinawa, as long as radar locks onto Japanese jets over the East China Sea, the contracts renew and the stock prices climb. The Japanese taxpayer pays for all of it, through income tax hikes starting 2027, through tobacco levies, through corporate taxes. A household already crushed by yen collapse is being taxed so that missiles can be aimed at the country whose cheap electric vehicles are simultaneously destroying Japanese automakers' market share across Southeast Asia. Japan is taxing struggling citizens to fund an arms race against its largest trading partner, whose economic collapse would devastate Japan's own export revenues. Read that sentence again. This is not theoretical. Real damage is accumulating right now. In November 2025, Prime Minister Takaichi stated a Chinese naval blockade of Taiwan would be a survival-threatening situation for Japan, legally opening the door for self-defense force deployment. Beijing responded with precision. Within days, Chinese airlines slashed Japan routes by 40%. State enterprises banned staff from traveling to Japan. Nanjing Airport individually questioned every Japan-bound passenger. China's Ministry of Education warned students against studying in Japan, and China is Japan's largest source of international students. By December 2025, Chinese tourist arrivals in Japan collapsed 45% year-on-year. Economic damage estimated at $500 million to $11 billion. Before accounting for trade disruption, investment freeze, or supply chain friction, accumulating month after month. On the commercial front, Chinese automakers were set to claim the #1 position in global vehicle sales for the first time in history, ending over 2 decades of Japanese dominance. In Indonesia, Thailand, Vietnam, markets Japan spent generations building, Chinese EV brands are taking share at a rate Japanese manufacturers cannot match. The weapons in this conflict are bond yields, credit ratings, tourist cancellations, and market share. And both sides are taking hits. China has the deeper structural crisis. Property debt hole 15 times Japan's 1991 disaster. Real GDP growth likely half of official figures. Working age population shrinking since 2021. In 2025, 7.92 million births, down from over 15 million just 7 years earlier. China is entering its own lost decade. The question is not whether, only how far and how long. But Japan has a crisis that can detonate faster. A bond market does not wait for demographics. It breaks in one morning. We watched the preview in January 2026. If Japan loses control of bond yields, if the 1.2 trillion yen carry trade that quietly funds U.S. tech stocks, emerging market bonds, and global real estate begins to unwind, the damage doesn't stay in Tokyo. It reaches every market, every pension fund, every mortgage rate on Earth. Most people see Japan and China as a distant geopolitical drama. They are wrong. The yen carry trade is inside your pension fund. Chinese manufacturing is inside your supply chain. Japanese government bond yields influence your mortgage rate. When these two economies bleed, the whole world pays the bill. Go to the comments. Answer one question. Do you think Japan is making a calculated strategic move? Or is this the most expensive financial mistake of the 21st century? There has never been a military victory that survived a financial collapse. You cannot sustain an arms race on borrowed money aimed at the economy you depend on for trade. History has no example where that ended well. Japan, record 122 trillion yen budget. China, 4th consecutive year of property sector collapse. U.S. Treasury Secretary, emergency call to Tokyo, both governments escalating with no off-ramp visible. Every serious analyst reaches the same conclusion. This does not end quietly. Either China's financial system cracks, releasing a deflationary shockwave not seen since the 1930s, or Japan's bond market fractures and $1.2 trillion in carry trade positions unwind overnight, draining liquidity from every asset class simultaneously, or the scenario serious risk analysts are quietly modeling, both happen in sequence, each one accelerating the other. The question is not whether a crisis is coming, but the cracks are already showing.